What's up, everybody? Welcome back to JMac Investing. My name is Jason, and today we're going to do part 2 in the series that I began called Investing in Stocks 101. Today the focus will be on investing your first $1,000 into the markets. I'm going to go over a couple starter portfolio examples that you could glean some insight from and maybe use as examples to begin your journey into investing. So that's what we're going to take a look at today. I hope you're enjoying the content, or if you're just finding me, please do me a favor, hit the like button if you're enjoying it, and subscribe if you haven't already, and hit the alert bell. That'll get you notified every time a video comes out. Make videos probably about 5 to 6 times a week. So thanks for tuning in. Let's jump right into the video. All right, guys, so like I said, let's jump into this video. And like I said, this is the second part in the series I'm calling Investing in Stocks 101. This one we're hypothetically saying that you have $1,000 to invest into the market to kick off your investing career, and I am going to propose to you a couple approaches to jump into that and to begin investing into the markets, no matter what level the markets are currently at, whether in the good times or bad. Just saying, you know what, I'm gonna go ahead and do it. You're gonna go ahead and just start investing today. So this is my main portfolio here on M1 Finance. Have links down in the description. If you're unfamiliar with M1 Finance, it is a investment platform that has no commission fees, and it allows you to purchase stocks and fractional shares. So that means you can get into any stock: Amazon, Google, Berkshire Hathaway, some of the really expensive ones, and you can just buy fractions of them. And the way they do it is it's a pie concept. So here's my main portfolio that under it has 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. I have 17 total pies inside my main pie portfolio, and each one of these in each pie is, in my case here, is stocks. In most of them, individual stocks, except for one that I have, which is ETFs. So I have a couple ETF. I have one pie that is dedicated to ETFs. So that's how it works. Essentially, you create, you structure your portfolio in pies, and then you set percentages on the pie. So of my 17 total pies, you see I have percentages set. This is the target percentage: 12%, 1%, 12, 16, 8, 9, 7, 1, 6, and on down the list. It has to, the way it works is, no matter which way you slice it, it has to add up to 100%, and you're good to go. You don't necessarily have to worry about trying to figure out buy orders and sell orders and trying to figure out all of the things that go along with it. You just set percentages, and if you have those percentages set, it will allocate your funds that you deposit into your account to that percentage weighting. So that's how it works. So once you're on here, like I said, I have a link in the description that'll get you a $10. Once you make your first $100 deposit, you'll get a $10 credit, and so will I. So it helps my channel out, and it helps you out. Helps you get 10% right up front. So use that if you're not already an M1 user. And if you're not, the same concept, these concepts that I'm going to present today, they'll apply. You can use the same. You'll just have to actually figure out the stock prices or ETF prices, and then allocate your funds accordingly, which makes it, with $1,000, a lot more difficult to get exact percentages set, because you have to actually get stock prices rather than percentages like you do here in M1 Finance, which is why I think M1 is superior. Other than some of the quirks that you'll find, that there's only has one window for buying and selling in the mornings every every day that the markets are open. So enough about M1. Let's get into the reason why you came. You're thinking about investing your first $1,000. So here on M1, you can go to the research tab, then you can go to my pies, and here you see I have a dividend starter portfolio example 2 and a dividend starter example portfolio example 1. So here's what I wanted to go ahead and check out for you. Is here is a example portfolio of investing $1,000. Actually, these returns are based on, right here you can see returns based on an initial deposit of $1,000. So if you, I'm sorry, this is returns based on an initial deposit of $100. So this is a 34%, 34.94% increase over 5 years. So in the case of $1,000 would be 3494 equals, so you would have gained $349. So in this case, with $1,000 rather than 100, this is going back 5 years. So performance history over the last 5 years would have been up 35% almost, gaining you $350. I'm not sure. Yes, it tells you and it breaks it down here. I'm not sure if this is factoring in reinvesting dividends, but anyway, so here you go. So I'm just let you know. So the way I approach this is I'm approaching this being this is your first $1,000, and being you're probably new to researching stocks, and being you're probably new to how to invest. And so what I've done is I've in this example portfolio, the first example is all ETFs, which are exchange traded funds that are each ETF is a basket of holdings. So it's a whole one ETF is a whole basket of stocks. And what that does is right off the bat, once you buy one ETF, you're automatically, however many stocks are in that one basket, you diversify your money that wide. So if it's 50 stocks in it, you buy one ETF and you're invested into 50 stocks. If it's like S&P 500 is 515 stocks. If you invest in one of the S&P 500 ETFs, you're investing into 515 companies with that one investment. So I did it this way to kind of dumb it down, and so that you as a new investor beginning coming into this thing, so you can kind of go ahead and put some money into the markets, and you don't have to put a lot of thought into it, and you can go ahead and then begin to let your money work for you, and at the same time begin to do research and see if you want to maybe begin to do your own individual investing into individual stocks, which is something you can do, but it's a lot more risky to do it that way, especially in the beginning. So this is a way to kind of go ahead and get you going and get you some money in the markets, and hopefully begin to make you a little bit of money while you research and learn the ropes. So here we go. So there is 6 slices in this portfolio, and you just kind of go on over it. You can see the expense ratio is 0.1%. So that's how much you have to pay for these ETFs per year. So 0.1%, which is very low. And this particular portfolio example is yielding 2.7%, which is pretty good. And it has 8 holdings. Those 8 holdings are the Vanguard S&P 500 ETF ticker VOO. It is, and that is the target on it is 25%. Then there's 20% allocated to a bonds pie. I made another pie, so you can add. You can do. I'll show you. You can do add. You can add from pies you've created. All right. So in this case, that came from my main portfolio. I have a bond pie, so I added it, and you'd select it, click add, but we already have it, so we don't need to do that. So that's where that came from. And I will go back here. So you have bond. So there's 3 bond ETFs in there. I'll go into it in a second here. Just want to go over the allocations. And then you have 20% invested into iShares Core Dividend Growth ETF. The ticker on that one is DGRO, and that is a ETF of all the stocks that compose it are stocks that are growing their dividend over time. And then 20% is allocated to VNQ, ticker symbol VNQ. That is the Vanguard Real Estate, made up of REITs, real estate investment trusts, which you typically pay a higher dividend, which are, I mean, over the course of time of recent, they've been beating the S&P 500, and this is composed of some very, very good, high quality REITs. So there's 20% allocated to that, and then there's 10% allocated to this SPHD. The ETF ticker on it is SPHD, and it's Invesco S&P 500 High Dividend Low Volatility ETF. And what that means is this is made up of stocks that pay a higher dividend, but they're less volatile, so a little bit more safe as far as having a high dividend goes. And then I figured, this one could be swapped out depending on I guess I'm in the way of it. Let me move me a little bit. Depending on if you're younger and you want to have a little bit more risk and a little bit more potential for, you can stomach a little bit more risk in your portfolio. This is Vanguard Information Technology, so it has your Amazons and Googles and things like that. So it's a little bit, it's the tech industry, high growth stocks. So that right there is so 25, 20, 20, 20, 10%, and 5%. And there you go. And what I did was, so each of these 1, 2, 3, 4, 5 ETFs, I pulled them up. So VOO, which is S&P 500, it is essentially the 515 companies that make up the S&P. Well, 513 says here. So this is from Seeking Alpha, and you can see, and see, that's what the beauty of it. See, one VOO ETF is $259. So you wouldn't really be able to, without using M1 Finance, to get exactly 30% on this one. You couldn't buy 2 of them, because if you did that, you'd be almost 50%, right? If you could buy one, and you'd be at 26% of $1,000. So that's why I say that M1 is a beautiful thing. When you're trying to allocate your portfolio, you can do it right down to the percentage and get it very, very specific and set up just like you want. So here's top 10 holdings, and you're going to have overlap in these. There's really no way of avoiding that. It seems like Microsoft and Apple are in like every ETF. I don't understand why. I know they're great companies, and they're like the top percentages of all of these. So you're going to wind up holding a lot of Microsoft and Apple if you're holding ETFs, because they're in dividend growth portfolio or ETFs. They're in the S&P 500. They're in, I think they're even in like the total market. There's another one called VTI, which I was debating on should I have the VTI or VOO or both, but there was just too much overlap for me to feel comfortable adding both of them. VTI is a much more diverse, it's like the total market, but you could, so here, instead of doing VOO, if you wanted broader diversification, you could remove VOO and add VTI, and that would give you exposure to over like 3,500 stocks rather than just the 500 in the Vanguard S&P 500. All right, so so this is your top 10 in VOO and the dividend growth. Here you go. This is what I was saying. You got Microsoft and you got Apple. So and here overlapping is Microsoft, Apple, JP Morgan, Johnson and Johnson, and don't see Exxon Mobil. But so other than those, then you begin to get into some other different companies. But all of these are companies that in the iShares Core Dividend Growth ETF, these are all companies that are growing their dividends, which is obviously what I'm into. I want all the companies possible that I hold that are dividend payers. I want them to be dividend growing dividend payers, not just paying out a dividend. I want them to be growing it, and then that way it compounds into your portfolio, and you begin to see just greater growth. And the ones that are growing their dividends are typically also growing their capital gains. That means the share price typically over time grows with it too. Whereas a lot of the ones that aren't growing, they kind of just stay flat. Then your next one is the VNQ, which I told you is the real estate ETF, the REIT. A lot of REITs here. So as you can see, it's made up of American Tower. It's the top 10%. So it's made up of another index, Vanguard Real Estate Index, which we could go into that and see, but we'll just kind of go high level on it. SPG, CCI, PLD, PSA, Public Storage, Welltower, right on down the list. So you can see, so this one is made up of 87% real estate, a little bit of communications. AMT is part of that. They're the cell phone towers. They lease the land to these cell phone companies to put up their cell towers. They have the land. And then you got basic materials and industrials and a little bit of cash here. SPHD, the S&P 500 high dividend, low volatility portfolio. And so as you can see, this one's a little different. They have like Ford, Invesco, Philip Morris, Kimco, Altria Group, ticker symbol MO, AT&T, Iron Mountain. These are all higher, high dividend stocks here. So this gives you that exposure and gets you a little bit higher dividend slice of pie. And then you got this. This is the one I was saying. Depending on your appetite, if you're young or old or conservative, or you want it to be a more aggressive portfolio, you could switch this out. You could remove, if you wanted to be more conservative, you could remove this and put this 5% on any of these other slices. So it's, again, Microsoft, Apple, but then you have the big growers, Visa, MasterCard, Adobe. Some of these I don't really consider huge growth companies. Like I don't consider Cisco, Intel as huge growth companies. But it's made up of 320 of them, and you can see, so over time, the summary of it. So it's done well, and it yields 1.19% dividend. All right, so there you go. So that's what that looks like. If you get down into the guts of it, it's just a bunch of really good companies, and with quite a bit of diversity. You're probably, I don't know, invested in 1,000, I would say 1,000 companies or so in this, with investing $1,000 in these targets, right? And you're getting 2.7%. So this, one more thing I wanted to point out, like this SPHD, if we go to the 5-year, so this is a monthly payer. It pays a monthly dividend. Okay. We got a white screen going here. Alrighty. Let me refresh this. Alright. Research pass. Alright, so And I was going to show you. So the rest of them are quarterly payers here, other than here in the bonds. So the bonds is made up of 3 different bond ETFs: long-term treasury, which is VGLT. LQD is investment grade corporate bonds, 40% treasury bonds, 35% investment grade corporate bonds, which are like AAA rated. And then you got a total bond market, BND, Vanguard Total Bond Market. And I think all of these are monthly payers. That one is. Guess the easiest way is just to go back in here. That one is. That one is, yes. And I'll just look it up, BND. And that one is. So all of your bonds are going to be monthly payers. So you have 3 ETFs here that are going to pay you monthly. They're going to pay their yields monthly. This is going to pay its dividends monthly. So you'll be getting some monthly. You'll be getting dividends paid to your account monthly with those, and then you'll quarterly be getting paid out in these others. So your portfolio will begin to grow off of dividends monthly and quarterly. Okay, so that kind of sums up a good way, I think, a good solid, well thought out, well positioned portfolio example for your first $1,000. Okay, all right. And then you may say, but yeah, Jason, I have a few stocks that I really want to individually invest in, and so I'd rather take that approach. And I say to you, I have a portfolio for you as well. So let's go here to my dividend starter portfolio example number 2, and you can see I have its performance a little bit better. I think the other one was 36% over 5 years. All right, so here's how it looks. It breaks down. I use all of the same ETFs. You got the DGRO, dividend growth. You got the VNQ. You got the bonds. You got the VOO. You got the SPHD, and you got the Vanguard Information Tech. All are still intact. Everything's the same. The targets are a little bit different. Okay. The only difference here with this portfolio is if you're adamant about going ahead, being new to investing, but you still want to invest in some stocks, what I did was I created another pie, and I did that, as I said, by creating a new pie, and you can see it's right here. It's this individual stocks pie. Okay. And you can see the performance of this one over 5 years just blows everything out of the water. But these are 5 of my favorite companies. But these could be your 5 favorite companies. So as you can see, once again, overlapped. You got Apple, Microsoft again. So there's 5 slices in this pie. In this pie, the 5 slices are Costco, Disney, Microsoft, Verizon, and Apple. And they are targeted 25% on the top 3, 15% on Verizon, and 10% on Apple. And as you can see, when you do pick individual stocks, which is the main advantage of individual stock picking outside of ETFs, is that they're 0%. Once you buy them and you got them in your portfolio, you pay nothing. You just own them, and you reap dividends off of them. So, so that's the pie that's inside of my dividend starter portfolio example number 2, and I'm going to show you. So what that means is this is made up of 5 stocks, right? 5. Okay, and I have a target of 10% set on that pie. Okay, so that means that you are no more than essentially 2% on one. There's no more than almost 2% into one company. That way, if one of your 5 companies goes to 0, you're not risking your entire portfolio. The risk level in your portfolio is really low because you're really diversified with the same, what do we say, maybe 1,000 companies in all of these others, right? and you still got you got 20% bonds, and then you still got your high growth tech stocks, and you still got your REIT, and you still got your S&P 500 and your dividend growers. But you're wanting to risk a little bit, and you're wanting to take a little bit more control of your portfolio. This will be a good way to do it to start with. Okay, you could put any 5 of your companies, or maybe you could do to provide less risk. You could put 10 companies there, and put maybe 10% inside of that pie on each company, and then you're only risking, you have 1% at risk in your main portfolio in one company. No one company is more than a 1% risk to you. So yeah, so this is a couple different ways, as I said, and what I'm going to do is also in the description. So I got the M1 Finance referral link, and I'm going to put these 2 pies. You can see there's the share this pie. I'm going to put the links to these 2 dividend starter portfolio, example 1 and example 2. I'll put those links in the description of this. You can grab a hold of them, and like I said, you could use this same philosophy with Robinhood or with Fidelity or Ameritrade, but you would not probably be able to get it targeted percentage wise like you could with M1. So but you're welcome to use these pies. I'll give you the link. The links also do have a referral link inside of them that you could use as well, but they'll be in the description. So I hope you guys enjoyed it. I think this will really give you kind of a maybe just what I tried to accomplish with this was to get your head space in a place where you're thinking about going into it with a diversified, kind of careful approach, especially early on. Once you become a better investor, once you become a better researcher of companies and stocks and financials of companies, you can begin to make shifts into the allocations and targets of your portfolio. But I think this will give you a good footing. And anyway, I'd love to hear each and every one of your comments about these kind of examples, and if there's something that you would throw in that you would maybe dial down, maybe you'd ramp up in yours if you were redoing your portfolio and starting over with $1,000, how you would do it. So just drop a comment and let me know how you would do it. So anyway, that's all I got today. I hope you guys, like I said, tune in soon as I'm putting out content regularly, and I'd love to also get some comments on some suggestions of things that you guys would want to see. So thanks for tuning in, guys. Deuces. If you go to my channel on YouTube and my channel header, there's 3 icons: my Twitter, my Facebook, and my Instagram. On all 3 platforms, it's at JMac Investing. Hit me a follow there. We can continue discussing.